For most of the last 75 years, the social contract was simple and deeply understood. If you worked hard, lived within your means, and saved consistently, one day you would own a home. Not a mansion, just a modest place to live, a foundation, a castle of sorts, something you could pass down to your children, a promise-shaped behavior, discipline, and long-term thinking across generations. But today, that promise is quietly being dismantled. And what's happening is not a normal housing cycle. It is something far more structural. What we are witnessing is a financial takeover of shelter itself. Housing did not suddenly become expensive because too many people wanted homes. It became expensive because homes were redefined. Somewhere along the way, shelter stopped being treated as a place to live and started being treated as a financial instrument, a yield generator. And once that shift happened, families were no longer competing with other families. They were competing with balance sheets. Before we go further, if you value calm, long-form explanations about money, power, and the systems shaping everyday life, this is exactly what we do here on Capital and Consequence. If this analysis resonates with you, take a moment to like the video and subscribe. It helps the channel grow and supports more documentaries like this one. For decades, Wall Street avoided single-family homes, not because they lacked value, but because they weren't scalable. Fixing toilets, mowing lawns, and managing thousands of individual properties across different neighborhoods didn't fit the financial model. Housing was messy, human, local. That changed after 2008. The global financial crisis became the single greatest transfer of property rights in modern history. Millions of families lost homes through foreclosure. At the same time, capital was searching for safety and yield, and that collision created an opportunity. Large financial firms looked at the wreckage and saw something families couldn't. They saw scale. They saw discounted assets. They saw a population that would be forced to rent. What followed was not accidental. It was coordinated. Government-backed agencies bulk sold foreclosed homes, not back to families, but to institutional buyers. Thousands of homes at a time. Entire neighborhoods transferred in single transactions. What could not be done one house at a time was suddenly easy to do in bulk. From Wall Street's perspective, the logic was clean. A house was no longer a home, it was a bond, a financial instrument that paid a monthly coupon called rent. And unlike traditional bonds, this one adjusted for inflation. Rent went up, costs were passed through. Yield was protected, shelter had been financialized. Today, when a young couple places an offer on a starter home, they are often not bidding against another family. They are bidding against an algorithm, an invisible bidder operating through an LLC. The algorithm scans neighborhoods, calculates rental yield, forecasts rent growth, and submits all cash offers with no contingencies in seconds. Humans don't compete well against that. These firms don't target luxury homes. They target the bottom rungs of the property ladder, the starter homes, the exact price range where middle-class families begin building equity. By absorbing these homes, they are effectively sawing off the ladder itself. Ownership becomes something you either already have or may never reach. High interest rates make this worse. Rising mortgage rates crush individual buyers. Monthly payments explode. Qualification disappears. But institutions don't borrow like households. They access capital at corporate rates, or they use cash. A 7% mortgage is irrelevant to them. It simply removes competition. The trap does not stop at buying existing homes. It expands into control. Entire subdivisions are now built exclusively for corporate ownership. Build-to-rent communities. These homes never hit the open market. They are designed from the ground up to be rental only. Permanent renter neighborhoods. Ownership is not delayed. It is structurally denied. At the same time, rental income itself is being securitized. Thousands of lease contracts bundled together into rental-backed securities. Once this happens, rent stops being flexible. It becomes a financial obligation, a promise to shareholders that rents will never go down, only up. Housing stops responding to local wages or conditions and starts responding to financial models. This is how a housing shortage becomes something deeper, a system, a structure, a pipeline that turns human necessity into predictable cash flow. What emerges from this is not just inequality, but something closer to neo-feudalism, a society divided between owners of assets and permanent users. The owners collect rent. The users pay forever. Housing becomes a subscription service. You pay monthly. You never own, you never escape. The most unsettling part is where the money comes from. Many of these firms raise capital from pension funds, public employees, teachers, firefighters, municipal workers, retirement savings. This means people are unknowingly funding the very institutions that are pricing their children out of homeownership. The system feeds on itself. The promise of ownership once created discipline. Save, plan, delay gratification. The new system does the opposite. It normalizes permanent renting. It removes the reward for patience. It tells people to subscribe instead of build. And once that mindset takes hold, it becomes very difficult to reverse. This phenomenon is not confined to one country. Canada provides a powerful case study. After 2008, the United States was forced to deleverage. Balance sheets were cleaned, lending standards tightened. Canada chose a different path. It doubled down. Housing became the primary engine of growth. Foreign capital poured in. Illicit money found safe harbor through shell companies. Real estate became a global piggy bank. The structure made it worse. Unlike the 30-year fixed mortgage common in the United States, Canadian mortgages must be renewed every 5 years. Millions of households are now facing payment shocks they cannot absorb. To avoid mass defaults, banks are extending loan terms to absurd lengths. Negative amortization, payments that don't even cover interest. 90-year mortgages, all to delay recognition of losses. This is not stability, it is suspension. Housing, once a source of security, has become a source of anxiety. Younger generations are told to work harder for less certainty, to accept permanent renting as normal, to subscribe rather than build. And as this mindset spreads, something deeper erodes. Faith in the system itself. Owning a home used to be a milestone, a signal that effort mattered, that patience paid off. In this new structure, ownership becomes an act of resistance, a way to opt out, to reclaim autonomy from the algorithm. None of this happened overnight, and none of it happened by accident. It is the result of incentives, cheap money, financialization, policy choices that favored yield over stability. And once these incentives are in place, behavior follows. This is why housing does not simply revert to normal, because normal no longer exists in a system built to extract rent, not provide shelter. Understanding this isn't about panic, it's about clarity. When you understand the structure, you stop blaming yourself for outcomes you don't control. You begin to see why the ladder feels missing, why the rules feel different. This is why we examine these patterns here on Capital and Consequence. Not to tell you what to do, but to explain what is being done. I'd like to hear your perspective. Do you believe housing can return to being shelter first? Or has it permanently become a financial weapon? Share your thoughts in the comments. And if this documentary helped you see the housing crisis differently, consider sharing it with someone who's living it. Subscribe to Capital and Consequence for more long-form analysis on money, power, and the systems shaping our lives. In a world built on algorithms, understanding the system may be the last form of independence left.